Unit 2, Private Mortgage Insurance and Participation Agreements. Introduction and Objectives. Lesson 1, Understanding PMI. Lesson 2, Split or Piggyback Loans. Lesson 3, Refinancing Existing Conventional Loans. Lesson 4, Participation Agreements. Types of Mortgage Participation Agreements. Partnership among mortgagees. Involves more than one mortgagee as owner of the finance instrument. Designed to finance large real estate projects. Each mortgagee puts up a share of the money and receives a commensurate portion of the mortgage payments. Includes mortgage-backed securities, REMICs, REITs, and REMPs. Partnership among mortgagors. Involves more than one mortgager as owner, sharing responsibility for payment of a single mortgage. Designed to finance a multifamily dwelling. Often called a cooperative. Partnership between mortgagees and mortgagors. Involves a mortgagee as both lender and part owner of the project. Designed to provide additional security on major commercial real estate projects. Ownership is not equal and can range from 5% to more than 50%. Makes the lender a partner in the project as well as the financier. The lowdown on refinancing. Refinancing an existing home mortgage seems like a good idea in some cases. To get a better interest rate. To cash out some equity. To shorten the mortgage term, from 30 years to 15, for example. To switch to a different type of loan, ARM to fixed rate, for example. Some things your clients should keep in mind when considering a refinance. A refinance is a new loan, so the following items come into play. New application fee. New title insurance. New appraisal. New loan origination fee. New closing costs. New term. Refinancing is starting over from day one on mortgage payments. Predatory lenders can make refinancing look good, when it's really not. Teaser interest rates can entice borrowers with super low rates for a set period, then they skyrocket. Cash-out options may seem appealing to borrowers, but will strip the equity they've built. Always encourage your clients to run the numbers before pulling the trigger on a refinance. Private Mortgage Insurance, PMI. Security for lenders. Required on conventional loans if the loan-to-value, LTV, ratio is greater than 75 to 80%, based on the lender, loan product, and borrower's financial information. LTV ratio requirements are in line with Fannie Mae and Freddie Mac guidelines. Rates can vary, depending on the credit rating of the borrower and the insurance carrier selected. PMI provides security for the lender, in case of default. Should foreclosure occur, the insurance carrier can pay the lender the full mortgage amount and keep the property, or it may choose to pay according to its policy, and the lender keeps the property. PMI premiums are required until the lender releases the coverage. Once the LTV ratio reaches 80%, the insurance carrier is no longer liable for defaults and coverage usually ceases, but the borrower has to request the termination of PMI. Under the Homeowners Protection Act of 1998, once the LTV ratio reaches 78% of the original, not current, value of the property, PMI premium payments have to stop automatically. Terminating private mortgage insurance. Great news for borrowers. Private mortgage insurance, PMI, on conventional loans, insurance required by lenders when borrowers have less than a 20% down payment, isn't required for the life of the loan. Keeping tabs on the following timelines can save borrowers thousands of dollars. Automatic termination. Lenders are required to automatically terminate PMI when the principal balance is scheduled to reach 78% of the original property value or at the midpoint of the loan's amortization schedule, even if it hasn't reached the magical 78%. Requested termination. Borrowers may request PMI termination from their lender anytime the principal balance goes below 80% of the original home value. The request for termination should be in writing. Lenders may require an appraisal to verify the property's value. Note, for either automatic or requested PMI termination, borrowers must be current on their payments at the time of termination.